Alrighty, we will go ahead and get started. My name is Kimberly Holder. I'm the Director of Marketing at Infinitas. So welcome to our mid-year update. This is one of our monthly educational Infinitalks that we do. This call is being recorded, and once it's approved by our compliance department, I can then email that out to everyone in case you have to jump off early, or if you want to share this with family or friends, you're welcome to do so. Each year around this time, we do try to do a mid-year update just to keep everyone kind of informed on how the year's looking and any information that you might need to know heading into Q3 and Q4. And we'll even talk a little bit about next year as well. So today we have Senior Partner Ray Evans, Partner David Pacer, and Financial Advisor Susan Geiersbach on the call. And Ray is going to kick us off.
Kimberly, thank you. Appreciate it. And thanks everybody for taking the time to visit today. As always, it's been a really interesting start to the year. And I think things I thought on January 1st, I don't necessarily think today. It's interesting that tailwinds we've had year to date. And it's interesting the asset classes that have performed well year to date. I'll go into detail on that in just a second, but a couple of tailwinds that I probably would not have expected as we had banking issues in the springtime and we had a couple big banks go out of business in the United States. Certainly that's disconcerting, but whenever the United States has issues regarding the banking system, usually the dollar takes a little bit of a hit globally from foreign investors, and the perception as the safest currency in the world suffers a little bit. Well, it isn't all bad. When the dollar declines in value versus other currencies, that's actually very good for non-US investments. So one of the things I think that's been a pleasant surprise year to date is that most people's international sides of their portfolios have done quite well. We'll go into detail a little bit on that in just a second. Second thing that's been a little bit weird in the United States is, it's exciting to have the main stock index, the S&P 500, do quite well, up 14 or 15% year to date. Having said that, it's interesting how narrow actually that has been driven by primarily technology stocks. And most of that is surrounding the excitement and maybe the hype and drama that's associated with Chat GPT and artificial intelligence. So virtually anything in tech has had a really, really nice bounce year to date, to the point that we're really, really cautious in terms of how we view tech and additions to tech and to growth stocks right now. It's pretty crazy if you examine some of the stats. The S&P 500 is 500 companies, right? 7 companies are basically responsible for 95% of the return of the S&P 500. So the other 493 basically have an average return of 0. So there's a real disparity between what we think represents excessive valuation and a real disparity between where we think there are real attractive valuations. And when we are meeting with clients, we certainly are trying very hard to make sure we rebalance into some of these areas that perhaps are a little bit undervalued. This is a busy chart, but I like to use this in most of our client meetings, and I'll take just a second to explain this. This is a graph going back to 2008, the far left column, and it goes 15 years through 2022. You'll notice the third to last column on the right is the year-to-date column. And so the way to read this, you guys, is the top row all the way across is the best performer each year. Going on down the line, the bottom row is the worst performer each year. Different asset classes are different colors. So on this graph, for example, small company stocks in the US is represented by the orange block. Real estate investment trusts are the light blue block, and so on. So different asset classes are different colors here. The first takeaway when you look at this is that there's no pattern. We wish there was a pattern. We would follow the pattern if there was a pattern that made sense. But winners rotate, and there's really no pattern to what wins and what declines. The page itself is really a case for diversification. Having said that, if you can focus on 2021 to begin with, And you'll note that it was a good year in a lot of categories. The top performer, real estate investment trusts, up over 40%. The green box, it's the S&P 500. Large company stocks in the U.S. up 28%. Kelly Green Box is commodities. That's the first year we've had inflation in a long time, and so on. So you can see that 2021 was a really fun. We had an awful lot of asset classes that had double-digit returns. 2022, one of the tougher years we've ever had. Commodities, the only asset besides cash that had a positive return. And again, when we talk commodities, we're talking oil, natural gas, agricultural stuff, minerals, natural resources, those kind of things. Cash was slightly positive, but virtually everything else was not only negative, but double digits negative. So it was super tough year to continue to, I guess, have faith in the fact that you've got assets in different asset classes. But if you could look year to date, as we were just saying, the top two performers year to date, again, the green box, the S&P 500, which right now is dominated by technology and tech stocks, up about 15% year to date. And then the second best performing, the light gray box, is developed markets, non-US, which is up about 10% year to date. So most categories are positive year to date. And you'll notice commodities, which have been drivers of success the last 2 years, are negative year to date. We think it's important not to give up on commodities. The Fed is likely to raise interest rates one more time, and maybe two. They indicated 1 to 2 more interest rate increases. We think that's going to happen for sure. I say for sure. We think one of the interest rate increases will be this month, and we hope that they're done. Susan's going to talk in a second about election years and election cycles and how they impact the market. But one thing to take away moving forward is that typically, as you go into an election year, it's actually a pretty decent historically year for stock and bond markets. The Fed tries generally very hard not to have an impact on the election by not raising or lowering interest rates during that time period. Can't guarantee they'll do that this year. The Fed currently tends to acquiesce to the White House pretty much right now. And then number two, as you go into an election year, particularly if you got an incumbent running, you don't have too many legislators who are looking to have any kind of tax increase as they want to get reelected. So we think we're actually entering a period that's going to be pretty robust. There's tons and tons of cash on the sideline. The last thing I'll leave you with, we track the assets in money market mutual funds, and it's normally about $3 trillion. And it's currently $5.5 trillion. So contrary to 2007, 2008, we're much more liquid than before. By the way, we can send these charts to you, this one, and I'm going to do one more real quick. We were talking about stocks in the U.S. And people say sometimes, well, let's play the percentages. Well, this is the percentages. I mean, this is the U.S. stock market, the S&P 500, going back to 1980. The gray bars going up are positive years. The gray bars going down are negative years. And if you just track this, 32 out of the last 43 years, going back to 1980, have been positive. It's about 3 out of 4 years, or about 75% of the time. If you actually took this back 100 years, it's very similar. It's 73 of the last 100 years are positive. So again, we had a tough year last year, 19% decline in the U.S. stock market. Would not be unusual to have a couple of robust years to rally from that. Again, I'll be glad to take questions after this is over. And if you'd like a copy of these graphs, they are approved for client use. So just let us know and we'll get this in your hands. Thanks.
All right. Thank you, Ray. With primary season beginning and an election year on the horizon, one common concern of investors is how the stock market will be impacted by an election, and particularly a change in the Oval Office. Data shows investors often get nervous because of fear and uncertainty surrounding elections and move into cash during election years. Net asset flows into cash and money market funds have been more than 3 times higher in election years than in non-election years. And while money market funds are more attractive than they've been in years, moving everything to cash and staying on the sidelines has rarely paid off. It's time, not timing, that matters most. Thank you, Kimberly, for pulling up this slide. So we pulled the last 20 election years, who was elected president, what the S&P 500 total return was each year since 1944. And as you can see, stocks have had a negative return in only 2 of the last 20 election years, 2008 and 2000. And both declines were largely attributed to asset price bubbles rather than politics. 2008, of course, with the housing market bubble, and 2000 with the dot-com bubble bursting. Stated another way, that means 90% of the last 20 election years provided positive performance. That's an A if we were grading a paper. Politics can bring out strong emotions and biases, and while current economic and political challenges may seem unprecedented at times, each past election cycle has had its own controversy or uncertainty. Looking as recently as 2020 and the coronavirus outbreak that surrounded that election year, COVID will probably be one of the most unprecedented events of our lifetimes. But even then, the market was positive overall in 2020 with the S&P 500 total return at 18.4%. Ray's previous slide showed that the market was down 34% at one point in 2020. So to end up at 18.4% and it being an election year really showcases the resiliency of investors, the market overall, and that politics doesn't actually play as big of a role as the headlines would have you believe. And not to overwhelm everyone with a bunch of numbers, but the average return of the S&P 500 over the last 20 election years is 10.94%. So it's not only positive overall, but also overall averaging double-digit positive returns, which is great. Kimberly, if you want to go to the next slide. Historically speaking, the results of the presidential election have essentially made no difference when it comes to long-term investment returns. The market has continued to be resilient over time, and U.S. stocks have trended up regardless of whether a Democrat or Republican won the White House. I'm sure some of you have seen a similar slide of how the market has performed over time if you had invested $1,000 in the S&P 500. But you probably haven't seen it based on if a Democrat or Republican was president. I like this graph because it clearly shows that whether it's red or blue, Democrat or Republican, election results have had very little impact on long-term investors. Sure, you're going to get some short-term volatility and bumps in the road, but as we can see over time, the market tends to go up. Data also shows primary season tends to be more volatile for the markets, but after primaries are over, the markets tend to calm down and even rise after the final candidates at the top of the ticket are chosen. So next year we could see some volatility as the primaries heat up, but overall the market tends to not ignore an election, but as I've stated, not have as much of an impact as we might perceive. Whether it's true or not, the partisan divide in our country feels wider than ever. The debate is noisier, the rhetoric is harsher, and social media and 24-hour news has a way of amplifying the loudest and sometimes most controversial voices. Politics can be an emotional game, and unfortunately, some of our worst biases and behavioral mistakes show up when we let emotions drive our decision making. Investing is no different. That's why your Infinitas advisor is here to work with you through the political noise and short-term volatility. We are focused on your long-term plan, regardless of the shifting political winds. And with that, I will hand it over to David to talk about good investment practices.
Great. Thank you, Susan. And thank you, Ray. Some very good, interesting points, some familiar faces we see in the crowd today. So thanks for joining, everybody. So the goal is, what do we do with all this information, right? Great information, diversification. We're showing you the history of the stock market during different events, different asset classes. So I'm going to share just a few investment techniques and strategies that are very common and historically have proven to provide good results. Many of you have heard of these, but again, it's just a good refresher. So Kimberly, if we could advance to the next slide, I'm going to talk about a couple different things. Obviously, you want to buy quality investments. Quality investments have weathered the storm for 50 plus years, even 20 plus years. That's a long enough time horizon to weather several corrections in the market. You know, it's hard not to talk with your neighbors or go to a party and you hear somebody talking about this wonderful stock that they invested in and made a lot of money on. And it's hard not to take that advice and just kind of do these one-offs. And our experience has shown that those one-offs don't always pan out the way that you'd like them to. So buy quality investments, companies that have good financial statements, you know, prove to pay dividends and have been around to weather the storms. This illustration here illustrates a strategy and a technique that we call rebalancing. And this is something that we do encourage all of you to do. If you're clients of Infinitas, you're already getting this technique done, depending on the advisor you work with and how often it's happening. But this is a good practice to follow. And what it illustrates is on the top left circle, you have 4 different colors representing 25% allocations. And just for illustrative purposes, we can just assume maybe the yellow is domestic stocks, the blue is international stocks, the red can be bonds, and the green can be real estate. And we know over time that not all investments perform the same. Ray illustrated that with that periodic table where there's no pattern. Each year, a different asset class performs differently. And so we all know that your portfolio, if you set it at 25% allocation each, we know that they're going to change over time. So if you go to the second circle, period 2, the red or the real estate in this illustration grew more than the others. It performed better, so now you have a larger weighting in real estate. Period 3, even more. And so what we'd like to do is get that variance back to whole. And by rebalancing, what you're doing is you're selling off some of those profits of what did really good and shifting those profits and buying into something that maybe didn't do as good that year. And so when you think about that technique, what are we doing? We're selling high, we're buying low. Selling high, buying low. It's such a simple concept to say and understand, but for many investors, it's hard to do. So rebalance is a great technique. We encourage you to do it at least once a year. Again, sometimes we do it more often depending on the strategy and goal of the portfolio. The next slide here, we're going to talk about another technique called reinvestments. And all these techniques work very well in down markets, up markets, and they can even help in flat markets. So reinvesting dividends is what this illustrates here. And the index that we're illustrating here is the MSCI World Index. So just like the S&P 500, this is a world index that encompasses all 23 advanced developed markets. And so there's going to be thousands of companies that represent this. But the average dividend in this index is 2.74% for the last 40 years. And a dividend is money that these investments pay back to their investors. Not all companies pay dividends. It's a very good indicator if a company pays a dividend and, more importantly, raises those dividends, that financially that company hopefully is pretty sound. And some people take those dividends and they put them to cash. Some people take those dividends and they live on the money as retirement supplemental income. But during an accumulation phase, we encourage reinvestment of those dividends because it naturally will buy shares when they're down, and you'll buy more when the price is down. You'll buy fewer shares when the price is up. And so this just illustrates not reinvesting dividends is the blue line. If you had reinvested the dividends, that's the orange or brownish line. And as you can see, the results are pretty astounding. More than double the growth and return by reinvesting dividends. And those are systems we have in place to reinvest dividends automatically. So it's a very easy technique to implement. This particular strategy worked very well last year. If you think about it, if you were in stocks or bonds, both asset classes went down. But had you been buying more shares last year at those very favorable reduced prices, now the prices are coming back. All those shares that you would have accumulated last year are now starting to blossom and appreciate. So you're seeing some great results if you implemented this technique. And then one more slide that we're going to cover here. And this is talking about cash. Both Ray and Susan talked about how much cash is on the sidelines in money market funds. You know, the good thing about interest rates going up 10 times in the last year and a half, because there is a good side to it, it's not always bad, is fixed income. Cash alternatives are now, and have been, paying a pretty decent interest rate. And so we're giving you 3 examples here. And this is a technique to think about if you have cash sitting on the sidelines. And when I mean on the sidelines, I mean maybe in a checking account or a savings account or literally under your mattress. If you have money that's not working for you, these are some very safe, conservative alternatives you can consider and make that money work for you. You want your cash to work hard for you. And it's pretty easy to do in this environment right now. So I'm just giving you an illustration of three ideas to consider. One is the top money market fund. Right now, the current money market funds we have access to are actually paying just over 4.9% right now. And these are liquid, so you can get in and out every day, no penalties. And an example here, putting $100,000 in at 4.9% interest, that's $4,900 a year of interest for $408 a month. So trying to give you some examples of really what this can amount to. Again, very accessible, very easy to get in and out. The second option is CDs. We've all heard of CDs before. And a year and a half ago, we were lucky to get 1% on a CD. Now, as you can see, CDs are in the 5.3, 5.4 range. And what's interesting about CDs, as we all know, they're FDIC insured up to $250,000. And with Infinitas, we have access to literally hundreds of banks across the country. So you're not having to go to the bank to access these CDs. We can get them right online through our portal. But if you look at these CD rates now, a 3-month maturity is paying the exact same as a 12-month maturity, which pays the same as a 6-month maturity. So we're in a crazy environment right now where the yields are virtually the same for short and I say long-term, but 1 year is not a long-term. So we're focusing on that shorter term rate. Going beyond 1 year, you're not getting the yield for it. So kind of stay within that time frame at this point, but we'll see what happens to these rates as the Feds meet again this month. And then the last example is individual corporate bonds. And see, these are investments that we can invest money into cash. Now, they're not as safe as a CD or a money market. Corporate bonds are issued by large corporations, as an example. Apple, Pepsi-Cola, Procter & Gamble. Lots of companies issue bonds as a way to raise money. And right now, individual corporate bonds are paying a pretty good yield. Right now, you can see on average, they're around 6.5%. And that is for a 12-month maturity. So similar to a CD, you do need to consider your timing and when you need the money. But corporate bonds are meant to pay interest. And as long as you hold the bond to maturity, the goal and the objective is to get that principal back. Now, they are not FDIC insured, so we need to be very careful on the companies that we do invest with. We want, again, high-rated companies that have good financial backing. So we know that there's an extremely high probability that it'll come to fruition. You'll get your principal back. So high-level summary, make your cash work for you if it's not. And that's going to wrap it up for my part of the presentation. I know we're going to open it up to questions. And I'll turn it back over to Kimberly, our moderator.
All righty, thanks everyone. This time we will open it up for questions. Let me just allow you guys to unmute. Alrighty, so now you should have the ability to unmute and ask questions if you'd like. Not everybody at once.
I just wanted to say I really don't have a question, but this is going to be very helpful because in working with Randy Johnson, I have a annual or semi-annual conference coming up next week. And so I've been taking notes. And so we've got a lot of things that we can be talking about. And as I get closer to retirement, it becomes a different shift in the way I'm looking at, what my assets can do and how they can work for me instead of me doing all the work for a change. So I just want to say thank you. I appreciate the information.
Yeah, thanks for joining.
Absolutely.
Absolutely.
Thank you.
Any other
David, I think you touched on this, but this could be a group for anyone in the question. But you talked about rebalancing and reinvesting. How is that done? across different accounts, like my retirement account versus maybe just like a individual account that I have. Is that the same strategy, or is there, how are you guys managing that behind the scenes?
Yeah, that's an excellent question. Because there is kind of a different approach to those. You have a retirement account in one hand, which when you do a rebalancing and you're buying and selling, there's no taxes that are generated. But when you're dealing with an individual account, which is taxable every year, you need to be mindful, and we are, that when you sell something perhaps that has a profit or gain in it, that will become a taxable event. And so as part of that procedure of rebalancing, now you have tax loss harvesting. That's a whole nother strategy we could talk about. We're not going to go into today, but yes, to answer your question, we do need to look at those a little bit differently from a tax perspective.
Can you hear me?
Yes.
Yeah.
This isn't necessarily a new concept, but I was wondering what thoughts you had on the recent BRICS currency goings on and what that might mean to the future.
Yeah, I'll tackle this and ride the fence completely. I don't think I know. I'm skeptical of digital currency personally. And I think the need to move pretty slow has been reinforced watching cryptocurrency over the last couple of years. At one point, and I even hesitate to use the term currency with crypto, several folks that we talk to are a lot smarter than me in this industry think of crypto, for example, as a speculative investment as opposed to a currency. So I guess until I have a better comfort level on what digital currency actually means, I'm pretty skeptical and hope that we move very, very slowly, personally.
That's even with the understanding that this is gold backed.
I don't know what that means after so many years of not being gold backed. So it could be great. And there's a part of us that are old enough to remember when things were completely gold backed and when we went off the gold reserve. So I don't really know what that means yet. And I don't really know if gold is the right reserve anymore. So I would just say I'm probably not smart enough to figure it out yet. And I don't mean to answer for everybody else, but I'm sure hesitant.
Thank you.
Any other questions? Alrighty, well, thank you everyone so much for joining us. I did want to mention really quickly that next month we have another Infinitalks on August 30th. It's about identifying your ideal claiming strategy for Social Security. So registration is live for that. You can go to our website and register for that, and we hope to see you then.
Did you say
Thank
that
you. Oh, sorry.
August 30th?
Yes, yeah, and that's
Okay.
on our website, infinitaskc.com/events.
Thank you so much.
Thank you
Thank you,
all very
everyone.
much.
Thank you, guys.
Appreciate it.
Thanks, everyone.